Hello, chart watchers and Decision Point faithful. Welcome to this June 13th, 2022 episode of Decision Point. My name is Erin Swenlin, and I'm here with my father, Carl Swenlin from DecisionPoint.com. And we're here to bring you the charts that we think you need to look at as you go into the week. And boy, do we have some great charts today, right, Dad?
Yes, we do. It's a continuation of the waterfall.
Yes, indeed. My trading room this morning was quite full of people wondering what the heck was going on. And so I will be talking a little bit about what I talked about in the trading room. And I know you have some great charts to show as well. So we're going to start off with Carl's grab bag, followed by the look at our indicators and your update on what's going on in Bitcoin, for example, and the dollar and gold. Then I'm going to take it over. We're going to look at two bear markets, back the .com and the housing crisis. And we're going to look a little bit and get some sense of the timing and the depth of bear markets. Then I'm going to look at the major indexes. And if we have time, I'll do the sector overview, but I definitely have two diamonds of the week for you that we will talk about. And let's start with the sector scoreboard and the Decision Point market index scoreboard. So these are telling us what the intermediate term trend model and long-term trend model signals currently are. Long-term trend model is when the 50-day is above the 200-day, that's a golden cross. That would be a buy signal. Opposite is a death cross, and currently all of the indexes have death crosses. Intermediate term trend model, that's where we track 20 and 50-day EMA crossovers, and we have 20-day EMAs all below the 50s. The difference between the neutral and the sell is that that the 20 crossed below the 50 while it was beneath the 200-day EMA. Those are sell signals. If it happens above the 200-day EMA, we go into a neutral cash or fully hedged position. And as far as the sectors go, we still have a little bit of green left, certainly on energy, which has been the big winner. But then you look at the others and we have healthcare, utilities, materials, consumer staples. These are all somewhat defensive areas of the market, particularly consumer staples and utilities and healthcare to some degree. So we're seeing the only long-term strength, and let's face it, Dad, I know when we look at those sector charts, that long-term strength is suspect for sure.
Right, especially right now with healthcare, that's the next one that's going to lose the buy signal and long-term buy signal.
And I expect before this is all over, all of these, except for energy, I think energy is going to survive, but I expect most of the others are not. So, all right, so let's go look at some charts. I'm going to pass it to you, and I think you're going to lead with Bitcoin.
Yes.
And it's interesting because the news today has not been about Bitcoin. It's been all about the market, but Bitcoin is having a pretty major big day as well.
Well, this financial news, I've been talking about it. You can see now, this is one of the few indexes we get quotes on Saturday and Sunday. So it actually dropped about 20% since the close on Friday. And I've been talking about this being major support here right around 28,666. And yes, it handily broke through that, as I say, Saturday and Sunday, and then today just continued on. So look, there's a little tick right here. We've got some support. It's actually stayed just about on that line. This is a more prominent support area with a couple of months of tops there. So that's right around 20,000.
Now, I remember, and I mentioned it in the trading room this morning, was that, early on, you were talking about, I think, the big double top or head and shoulders. And I remember you telling people that you could actually see Bitcoin moving down to that 10,000 or 15,000 level. And I just remember everybody thought you were so crazy at the time. But now, I mean, you're looking pretty smart, as I already know you are.
Well, and yeah, I remember we pointed this out maybe a month ago. We started looking at this support, and that's when I started thinking that we were going to lose this. And this is the beginning of the end for cryptos, as far as I am concerned. Yeah, 10,000 is just a little ways away now, and we'll see it soon, I'm sure.
Mm-hmm.
I'll just take a quick peek at Ethereum. Looks pretty much the same. Won't get too much involved with that. Let's just go with, get rid of that and start with the market. Again, waterfall decline. And right now I've got a question mark. We could possibly get a double bottom set up here. Always be looking for it when you get this close to another bottom, recent bottom. We're getting acceleration in volume, expansion in volume. And look at well, of course, we got this crossover. Now, we've got a PMO bottom, a top below the zero line, which is really always a bad thing. However, let me show you, while we're looking right here, we're at the bottom of the chart for the VIX on our reverse scale, inverted scale picture here. But let's go out, let's drag it out to 20 years and see what, no, I don't want to do that. Let me, no, I want to do that on the next chart.
There you go.
Yeah. Okay. So, little different picture here. 20 years. All right. A little bit congested, but notice how the VIX is gotten much lower at various bear market bottoms. And it's a similar low at the 2000. Yeah, this is it right here. So we've got a lot of ways to go on the VIX before people are starting to get panicky. It's surprising with what we've seen how people just aren't.
Everybody says that we're throwing the word capitulation around and not distribution. Maybe people are still in distribution mode, but we need capitulation before we're going to see the end of this. And there are just too many people who still are holding out hope.
Yep. Let's look at the new highs and the new lows today. Okay.
Ooh.
So we are lower spike today than this. So no divergences at all. And again, I think there's no sign that it's going to stop yet.
Mm-hmm.
Let's look at the Silver Cross Index for today. So it turned back down. The large caps, it's at 24, mid caps 30, and the small caps at 30. So it's still dropping and definitely bear market territory. I wanted to look at the weekly chart. Notice it's down 22% now. This is the next level of support that I'm seeing, but it's kind of thin. This area right here is the next, that's 3,500 on the S&P 500. So that's the next area of support that I see. And let's look at the monthly too. Normally, but here it's getting down to this level. And again, 3,200 or 3,500 right here. That's the next level. PMO crossing over the signal line down. That's, a top and a crossover. It's a pretty serious situation. Okay, climaxes. We got a climax today for sure.
Yeah, I imagine we did.
We're waiting for the New York stuff to come in, but notice we got a 74 level on the down divided by the up volume ratio. And it's easy for the S&P to get really high readings, but I expect we'll see something like this from the New York Stock Exchange. We've had initiation, downside initiation, and exhaustion. And there's not any way to say that it's over. It could be over tomorrow morning, who knows? But right now, I wouldn't count on it.
Yeah, and we, like you said, I mean, we've gotten these downside exhaustions, meaning you're supposed to look for something to go up, but really they're not. Basically, most of those bullish climaxes have not been materializing in higher prices, and I think that's certainly another indication that things are bad.
Right. We're getting oversold on the short-term indicators, very oversold. So again, we could possibly look for a bounce in the short term. Intermediate term indicators, not even starting to be oversold. And you notice we got a lower top on this most recent price top. And that's not even a good sign. We're going to look for, I would be looking for oversold levels down in here, something like that. Maybe down as low as 200 here.
We got a long way to go.
Yes, we do. Okay, we've done Bitcoin. I want to do the 10-year treasury bill, our bond yield, and it's going through the roof. Yield array. This isn't updated today, so that this will be much higher on all these, I'm sure. Dollar index is just staying strong, and that is not good for gold. We had a nice uptick on Friday, but just reversed down today. Yeah. So I'm looking right now for this to be the next support level on gold. Now, my theory is that with cryptos going in the toilet, that gold will be rediscovered. That's my working theory. Mm-hmm. About to happen at any time.
Yep. I'm waiting now for that bounce. I was waiting for the breakout to pad my gold position. Now I'm going to wait for the bounce off of that support level. Because I'm with you. I think gold's going to definitely turn around here.
USO crude oil, and it's still in a rising trend, but it's pulled back the last 3 days. Treasury bills.
Yeah. Finally lost support.
Yep, they did. And your PFIX is the one you like.
Yes, I have a chart of that. You don't need to put it up.
Okay, you're gonna.
Don't steal my thunder.
Don't steal the thunder. All right. Then I think that I've covered my ground. So
okay.
I'll turn it back to you.
All right. So I'm going to start with the history lesson, if you will. All right. So .com bear market, housing crisis bear market. So one of the things I was reading Greg Morris's amazing book, one of the Bibles of technical analysis, Investing with the Trend. And in there, he has a chart, a table that basically tells us when these bear markets started, when the trough was, and when recovery was. And it was very eye-opening to me. So I don't know if it's going to be eye-opening to other people that lived through it. But the one thing I wanted to point out is that these things go a long time. And, everybody says the 20%, now you're in a bear market. So now it's time to come out because you've been down 20%. It doesn't work that way in a bear market. So we had the top back here in March of 2000. We did not hit a trough until 2002. So what are we looking at? At least a full year and a half. It was 30.33 months in length. And the crazy thing is we didn't actually recover until 2007. So it took a long time just to gain back the ground that was lost back in 2000. Then we went through, as soon as it hit that point of recovery, it went immediately into another bear market. This one lasted 6.9 months. It was a lot deeper. But the worst part of this one is that we did not see recovery until about 2012. So it could take a long time just to get down there, and then it might take a really long time just to recover from it. So just something to consider. So that was one of the charts that I really wanted to show today. And the next one, we're going to go over what the indexes are doing, because I had somebody asking me about, what about the other indexes? So here is the Dow. You can see we just got that PMO sell signal today. We were already getting the 5-day had crossed below the 20-day. We already knew there were problems going on here. So where's support? Well, most of these charts, you have to go into a weekly chart just to see where the support might lie. And here we go. To me, you were pointing out this level here, which is certainly, a possibility. This is the Dow. I'm looking definitely at these 2019 top here, or 2020. I apologize. The early, right before COVID, that was my look for when the bear market might be over. I'm certainly changing my mind. Things are looking way too negative, but that's the Dow. NASDAQ, of course, lost a lot here. And again, we have to go into weekly mode in order to look for support levels. We lost this level, this support zone, earlier last week. Now we have this low here that maybe can help us out here for the NASDAQ 100. But again, I think these 2020 highs here are going to be what we're going to be looking for. So we're looking at least another 7% down on the NASDAQ, in my opinion, and more than likely at least another 14% just to get down here. So it's
Are you saying that that's a probable end of the bear market?
I'm not saying that. That's what I was thinking originally, but now
okay.
When you look at this and see the acceleration downward, this just doesn't look like that strong support level. It just doesn't. So that was where I was looking. But the key is just knowing that these two support levels that are possible bear market rally zones anyway are still very much further down than where we're at.
To get the S&P down to undervalued, it's going to be 60-70% decline.
Yeah.
That's
exactly.
Yeah.
So, and this, just to get back there, is another 9.7%. That just doesn't sound likely as the end of this. It just doesn't. Unfortunately, sorry guys, hate to give you the bad news. So quick look at these sectors, the sector candle glance. All of the sectors have PMOs that are pointed downward. Some are in worse shape than others. Most of them have PMOs that turn down below the zero line. Look at comm services way below the zero line. XLK, all of these below the zero line on the PMO, with the exception of utilities, which is of course a somewhat defensive area. And of course, energy hasn't had that problem. We also got a top on materials that wasn't below the zero line. But ultimately, when you look at this, you can see that support is broken on these. You can't see this next support levels in most cases. With utilities, we do at least see support levels down here at about 65, 66, but we've broken that support level. Industrials testing support, but really the closing low is way up here. So I'd say that support's really gone too. But it's just a pretty ugly situation. I don't think we need to tell you that, but just to get a really good sense. XLY is sitting on support. There's some possibilities there, but again, I think at this point, it's all about being in cash or looking at some of the inverse ETFs or different hedges. And see, that's where I was going with this. So PFIX, yes. And I pointed this one out to, you talked about it originally, I'm thinking 2 months ago, at least, about this one.
Yeah.
And it basically follows the interest rates. And clearly, this is, full disclosure, I do own this one, and it's the only thing that really made today okay for me. It was, everything else was way down, but this one sort of cleaned up all of that. It was a perfect hedge. It kept my portfolio from disaster. So I think this is a really great hedge ETF right now to look at. Yes, this is like a parabolic move, but as we've seen, interest rates don't look like they're going to come down. And I will show, you didn't show it and it takes forever to load, but I think it's worthwhile.
Let me just say that the PFEX is functionally similar to owning long dated put options on the 20-year T-bonds. I looked that up today.
Oh, okay, cool. So the technicals look good, but here's the chart I'm going to throw here to tell you why I think that this is still going to be a good place to be. So right now we're breaking almost above this support level of 2018 on these. And actually this hasn't been updated since Friday. So I bet we're above these support level or this resistance level right here. But the key is to note we've lost this declining trend. We got the breakout. Now we're getting a breakout above resistance. And as I pointed out in an article that was reprinted over the weekend for chart watchers, the conditions are very similar to the 1979-1982 area as far as inflation, as far as high oil prices. We haven't gotten to gas lines at the pump yet, have we? And then the housing prices moving up. So that really, helped interest rates really spike. I don't think, we're going to see these levels, but what it does tell you is that this resistance and even this resistance level, this seems like a more likely resistance level up at 5. So I would be looking for rates up there at 5% at a minimum, but we'll see. And that actually, that's one of the things I did not talk about on this bear market chart, and I have a few more minutes, is the fact that what led to each of these bear markets. And .com was led into because of frenzied buying of tech stocks. Sounds very familiar. The only difference, of course, is that, most of those stocks that came in that had that frenzied buying really didn't have a track record of profits. They didn't have business plans, really. They didn't have products. And I remember you and I talking about that back then. It was, I was saying, hey, all the tech stocks, everything's looking great, and you were just like, I don't get it. I think kind of like Bitcoin, right?
Yeah, exactly.
I don't get it. And so that, of course, led to it. So we've had this frenzied run up in technology. This is the housing crisis, right? Well, we're not in that subprime mortgage place that we were there, but we do have skyrocketing high prices. We now are seeing the mortgage rates moving up. And I've actually started getting emails and phone calls from mortgage companies offering no income verification.
Oh, geez.
That was like the first sign, wasn't it, here?
Yeah. Yep.
I'm waiting for the interest only and below interest only loans, because then I know. The point is that we are now not only experiencing some of the things here that we had before, but we're also, we have the added global conditions with the war. We have, there's so many additions to this. We weren't dealing with the high inflation that we're dealing now back again. There are things now, I remember we were talking about it a long time ago, probably, but multiple bubbles.
Right.
And that's kind of where we're at.
The Fed has been stealing from savers for the last 15 years to the benefit of speculators. And that's why the market is so high. And now it's going to be paid back.
That's right. That's right. Our savings account's going to become a little bit more friendly, I'm wondering.
Yeah, maybe like have pay some interest. Yeah, we'll see.
Yeah, exactly. All right. So diamond of the week was PFIX for sure, but a couple of other inverses. And I think in prior shows, we've talked about them. These are ultras. These are juiced. So I always caveat that. Basically, when you get into a juiced ETF, for example, a 2 times, you should now double your stop level, meaning you need to be able to deal with some serious volatility to the downside. And you need to, position size appropriately, maybe half of the position you would have taken if it weren't an ultra ETF. So that's what I'm going to preface before I get into some of these. But these are a few that it come to mind when I was doing this. And the first is, of course, the QQQ. A short on that obviously was looking good. In that same vein is SOXS. And this is the semiconductor short ETF. And that one's up quite a bit today. It hasn't gotten above this resistance level. I suspect it will, but we may have to deal with some more volatility here on these. So just think about that before you get into them. But here's SDAO. That's another one that I've been looking at as well. I think this is no, it's not that one. I can't remember what that one is, but in any case, we're wrapping it up here. I think that these inverse ETFs are going to be a good call to be considering as a possible hedge. But I do have to say, and I'd be interested in your opinion, but someone was telling me in the trading room that you're better off shorting the regular ETF. So for example, shorting the SPY versus getting an inverse. And I can't remember their reasoning, but there was fees involved or something to that. They don't track as closely.
Okay, I think I would agree with that. Yeah, but
yeah,
everybody should do their research before they use these.
Yes, exactly. But this is kind of an easy way to protect what you already have out there if you just have to stay in the market. The best protection, and the protection that I use, is moving to cash, because nothing can happen to my cash.
Well, not while Congress is out of session anyway.
Exactly. So yes, cash positions. That's really what I do is rather than be in, I will do that. But right now I still am bullish on energy. I'm bullish on gold. And so I do want to have something in there that's an additional hedge for, when things kind of go the wrong way, like they did today on some of the energy stocks that I own. So all good to know. But like I said, just remember history here. This is not over. And when you look at the kind of run up that we've had, it's just kind of inevitable. And the current concern is, again, what do you do during this period of time? And it's, you're better just being out or considering some hedges. And there are some, shorting opportunities. I know with DP Diamonds, that's where I'm going to go. That's all we have for you today. Good luck and good trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.